Good afternoon, friends. You are most welcome to Think IS channel. Today we are going to discuss India Yearbook 2022 GIST, which is written by GS Score. Our topic is finance. Let us begin the topic. The Ministry of Finance is responsible for administration of finances of the government. It is concerned with all economic and financial matters affecting the country as a whole, including mobilization of resources for development and other purposes. It regulates expenditure of the government, including transfer of resources to the states. This ministry consists of 5 departments, namely Economic Affairs, Expenditure, Revenue, Investment and Public Asset Management, and Financial Services. Department of Economic Affairs. The Department of Economic Affairs is the nodal agency of the government to formulate and monitor countries' economic policies and programs having a bearing on domestic and international aspects of the economic management. A principal responsibility of this department is the preparation and the presentation of the union budget, including railway budget, to the parliament, and the budget for the state governments under president's rule and union territory administrations. Annual financial statement, that is the budget. The annual financial statement is popularly known as the budget. It is presented to the parliament by the finance minister each year on the first working day of the February. Under Article 112 of the Constitution, a statement of estimated receipt and expenditure of the Government of India has to be laid before Parliament in respect of every financial year. This statement, titled Annual Financial Statement, is the main budget document. The annual financial statement shows the receipt and payment of the government under the 3 parts in which government accounts are kept: consolidated fund, contingency fund, public account. Demands for grant. Demands for grants. The estimates of expenditure from the consolidated fund included in the annual financial statement and required to be voted by the Lok Sabha are submitted in the form of demands for grants in pursuance of Article 113 of the Constitution. Generally, one demand for grant is presented in respect of each ministry or department. However, in respect of large ministries or departments, more than one demand is presented. Each demand normally includes the total provisions required for a service, that is, provision on account of revenue expenditure, capital expenditure, grants to state and union territories, governments, and also loans and advances relating to the services. Financial bill or finance bill. At the time of presentation of the annual financial statement before Parliament, a finance bill is also presented in fulfillment of the requirement of Article 110, Clause 1, Clause A of the Constitution, detailing the imposition, abolition, remission, alteration, or regulation of taxes proposed in budget. A finance bill is a money bill. Appropriation bill. After the demands for grants are voted by the Lok Sabha, Parliament's approval to the withdrawal from the consolidated fund of the amounts so voted and of the amount required to meet the expenditure charged on the consolidated fund of India. Appropriation bill. After the demands for grants are voted by the Lok Sabha, Parliament's approval to the withdrawal from the consolidated fund of the amounts so voted and of the amount required to meet the expenditure charged on the consolidated fund of India. Fund is sought through the appropriation bill. Balance of payments. India's current account balance recorded a deficit in quarter 3, October to December 2020-21. Underlying the current account deficit was a rise in the merchandise trade deficit and an increase in net investment income payments. Private transfer receipt, mainly representing remittances by Indians employed overseas, declined marginally on a YOY basis but improved sequentially. Net foreign direct investment (FDI) recorded robust inflow. Sources of revenue. The main sources of union tax revenue are custom duties, union excise duties, service tax, corporate and income taxes. Non-tax revenues largely comprising of interest receipts, dividends or profits, fines and miscellaneous receipts collected in the exercise of sovereign functions, regulatory charges and license fees, and user charges for publicly provided goods and services. Public debt and other liabilities. The public debt of India is classified into three categories of union government liabilities: internal debt, external debt, and other liabilities. Internal debt for Government of India largely consists of fixed tenure and fixed rate government papers, dated securities and treasury bills, which are issued through auctions. These include market loans, dated securities, treasury bills 91, 182 and 364 days, and 14-day treasury bills issued to state governments only, cash management bills, special securities issued to the Reserve Bank of India RBI, compensation and other bonds, and non-negotiable and non-interest bearing rupee securities issued to international financial institutions and securities issued under market stabilization scheme with a view to reduce dependency on physical gold and reduce imports. External debt represents loan received from foreign governments and multilateral institutions. The Union government does not borrow directly from international capital markets. It, its foreign currency borrowing takes place from multilateral agencies and bilateral sources and is a part of official development assistance ODA. At present, the Government of India does not borrow in the international capital markets. Other liabilities not a part of public debt includes other interest-bearing obligations of the government such as post office saving deposits, deposits under small saving schemes, loans raised through post office cash certificates, provident funds and certain other deposits. The Reserve Bank manages the public debt of the central and the state governments and also acts as a banker to them. Social sector programs. The flagship programs continued to receive high priority. Direct benefit transfer (DBT). Direct benefit transfer is a major reform initiative launched by the Government of India to provide an overarching vision and direction to enable direct cash transfer of benefits under various government schemes and programs to individuals. Leveraging the gains in आधार प्रोजेक्ट, इसको फिर से देख लेते हैं. डायरेक्ट बेनिफिट ट्रांसफ़र DBT is a major reform initiative launched by the Government of India to provide an overarching vision and direction to enable direct cash transfer of benefits under various government schemes and programs to individuals. Leveraging the gains in the Aadhaar project, DBT was conceived with the objective of accurately targeting the intended beneficiaries and enhancing efficiency, transparency and accountability in the delivery of benefits or services under government schemes. The mandate of DBT was universalized and extended to cover all central sector schemes and centrally sponsored schemes that have any component of cash benefit transfer to individual beneficiaries. Atmanirbhar Bharat, which translates to self-reliant India or self-sufficient India, is a policy for making India a bigger and more important part of the global economy, pursuing policies that are efficient, competitive and resilient. Under the policy, not only should products be made in India, but the promotion of those products should take place so as to make those products competitive. As part of Atmanirbhar Bharat package, numerous government decisions were taken such as changing the definition of MSME, micro, small and medium enterprises, boosting scope for private participation in numerous sectors, increasing FDI in the defense sector, etc. Pradhan Mantri Garib Kalyan Yojana PMGKY, which was launched by the Government of India in 2016, was a voluntary disclosure scheme to declare unaccounted for wealth and jewelry. The government stressed on the issue to divert the excess wealth of some of the welfare of poor and the underprivileged. Social benefits under the PMGKY was extended to economically vulnerable households till March 2021 in view of COVID-19 pandemic and related lockdowns. Under the scheme, 81 crore individuals are being provided with 5 kilos of rice or wheat and 1 kilo of chana every month. The fresh stimulus includes cash transfer to 20 crore Jan Dhan accounts. Public debt. Public debt includes internal debt comprising borrowings inside the country and external debt comprising loans from foreign countries, international financial institutions, etc. Green Climate Fund. The Green Climate Fund GCF is a multilateral fund created to support the efforts of developing countries to respond to the challenges of the climate change. So far, 43 projects have been approved by the board of the GCF, Green Climate Fund. India also has one project approved by the board with NABARD on groundwater recharge and solar micro irrigation to ensure food security and enhance resilience in vulnerable tribal areas of Odisha from 16th GCF board meeting. GCF is Green Climate Fund. Economic growth. The imposition of strict lockdown and social distancing measures taken to combat the spread of COVID-19 had adversely affected the economy. The growth rate of the gross domestic product GDP at constant market price has been estimated to contract by 8% in 2020-21 as compared to the growth of 4% first revised estimates recorded in the previous year. Prices. Headline inflation based on consumer price index combined CPIC declined in January 2021 to 4.1%, mainly due to decline in the food inflation to 1.9% in January 2021 and from 3.4% in December 2020. Wholesale price index WPI inflation averaged 0.2% during April to January 2020-21 and stood at 2% in January 2021. Now we will discuss about climate change. Climate change is one of the most compelling global challenges. To counter it, India submitted its nationally determined contribution NDC under the Paris Agreement on the best effort basis, keeping in mind the developmental imperatives of the country. In the NDC nationally determined contribution, India promised to reduce its emission intensity of GDP by 33 to 35% below 2005 levels by 2030. 40% of cumulative electric power installed capacity would be from non-fossil fuel sources by 2030 and increase its forest cover and additional carbon sink equivalent to 2.5 to 3 billion tons of carbon dioxide by 2030. Credit growth stood at 5.9% in 2021. The moderation in credit growth in 2020-21 was witnessed in mostly all the sectors barring services. Service sector. The COVID-19 pandemic, the subsequent lockdown and social distancing measures have had a significant impact on the contact-intensive service sector. During the first half of the financial year 2020-21, the service sector contracted by almost 16%. This decline was led by a sharp contraction in subsectors, particularly trade, hotels, transport, communication, and services related to broadcasting. The pace of recovery through after the second COVID wave was seen and is broadly aligned with high frequency indicators that point to a peak in economic momentum with the measured opening up of the economy from June 2020. Air passenger traffic, rail freight traffic, port traffic, foreign tourist arrivals, and foreign exchange earnings all contracted sharply following the first lockdown, which was announced in March 2020. As the economy gradually entered the unlock phase, most of these indicators showed signs of recovery. Social infrastructure. While the COVID 19 pandemic caused its ripples on the economy and on the social sector, governments at the center and states intervened in a timely manner to respond to the pandemic. Increase in social service expenditure was witnessed across health, education, and other social service sector. Allocation for the health sector during the COVID-19 times flowed especially towards containment and treatment of the COVID virus. Major policy changes in banking regulations, commercial banks, merger of the PSBs, consolidation among another 10 PSBs, with Punjab National Bank, Canara Bank, Union Bank of India, and Indian Bank as anchor banks came into effect from April 1st, 2020. Restructuring of MSME loans. A one time restructuring of loans to MSMEs that were in default but standard as on January 1st, 2019 was permitted without an asset classification downgrade, subject to certain conditions like aggregate exposure, including non-fund based facilities of banks and NBFCs to the borrower not exceeding 25 crore rupees. Large exposure framework. A bank's exposure under the large exposure framework to a group of connected counterparties was increased from 25% to 30% of the eligible capital base of the bank. The increased limit was applicable up to June 2021. Export credit. The maximum permissible period of the pre-shipment and post-shipment export credit sanctioned by banks was increased from 1 year to 15 months for disbursement made up to July 31st, 2020, in line with the relaxation granted in the period of realization and repatriation of the export proceeds to India. Export credit. The maximum permissible period of pre-shipment and post-shipment export credit sanctioned by banks was increased from 1 year to 15 months for disbursements made up to July 31st, 2020, in line with the relaxation granted in the period of realization and repatriation of the export proceeds to India. Monetary policy transmission. External benchmarking of loans. RBI deregulated the interest rates on advances by SCBs, including RRBs. Scheduled Commercial Bank SCB. RRB, Regional Rural Banks, with a view to strengthen the transmission of monetary policy. The banks were mandated to link all new floating rate personal and retail loans and floating rates loans. Banking sector. The performance of the banking sector domestic operations, public sector banks PSBs in particular, improved in 2018-19. The gross non-performing advances GNPA ratio of scheduled commercial banks decreased from 11.2% in March 2018 to 9.3% in March 2019, and their restructured standard advances RSA ratio decreased to 0.4% in March 2019 from 0.9% in March 2018. One-time restructuring of loans to MSMEs. The scheme was made available to MSMEs qualifying certain objective criteria, including inter alia a cap of 250 million rupees on the aggregate exposure of banks and NBFCs to an MSME as on January 1st, 2019. The restructuring was to be implemented by March 31st, 2020, and an additional provision of 5% to be maintained in respect of accounts restructured under this scheme. Insolvency and Bankruptcy Code. A bankruptcy law reforms committee was set up in 2014 for providing an entrepreneur-friendly legal bankruptcy framework for meeting global standards, for improving the case of doing business, ease of doing business with necessary judicial capacity. A bankruptcy law reform committee was set up in 2014 for providing an entrepreneur-friendly legal bankruptcy framework for meeting global standards, for improving the ease of doing business with necessary judicial capacity. Accordingly, the Insolvency and Bankruptcy Code IBC 2016 was brought in. The code aims to promote entrepreneurship, availability of credit, and balance the interest of all the stakeholders by consolidating and amending the laws relating to reorganization and insolvency resolution. The code aims to promote entrepreneurship, availability of credit, and balance the interest of all the stakeholders by consolidating and amending the laws relating to reorganization and insolvency resolution. Financial Stability and Development Council. With a view to strengthening and institutionalizing the mechanism for the maintaining financial stability, enhancing inter-regulatory coordination, and promoting financial sector development, the Financial Stability and Development Council (FSDC) was set up as the apex level forum in 2010. Financial Stability Board FSB was established in 2009 under the aegis of G20 by bringing together the national authorities, standard setting bodies, and international financial institutions for addressing vulnerabilities and developing and implementing strong regulatory, supervisory, and other policies in the interest of financial stability. Infrastructure financing. Given the enormity of the investment requirements and the limited availability of public resources for investment in physical infrastructure, it is imperative to explore avenues for increasing investment in the infrastructure through various sources. In view of this, the government launched the following to mobilize the long-term investment on infrastructure in the country. In view of this, the government launched the following to mobilize the long-term investment on infrastructure in the country. First is bank financing. Banks continue to be the major source of financing infrastructure. Institutional finance. The government has also set up India Infrastructure Finance Company Limited (IIFCL) with the specific mandate to play a catalytic role in the infrastructure sector by providing long-term debt for financing infrastructure projects. Infrastructure Debt Funds (IDFs). Government of India has conceptualized infrastructure debt funds (IDFs) to accelerate and enhance the flow of long-term debt into infrastructure projects, to help in the migration of the project loans for operating assets from banks to the fixed income markets. Real Estate Investment Trust (REITs) or Infrastructure Investment Trust (INVITs). These are trust-based structures that maximize returns through efficient tax pass-through and improved governance structures. Public-private partnership (PPP). Availability of quality infrastructure is a prerequisite to achieve broad-based and inclusive growth on a sustained basis. Infrastructure is also critical for enhancing productivity and export competitiveness. Given the enormity of the investment requirements and the limited availability of public resources for investment in physical infrastructure, the projected infrastructure investments made it imperative to explore avenues for increasing investments in infrastructure through a combination of public investment and public-private partnership (PPP) mode. Information dissemination. DEA maintains a website dedicated to PPP to provide information related to public public-private partnership (PPP) initiatives in the country. DEA, Department of Economic Affairs, Department of External Affairs, Department of Economic Affairs maintains a website dedicated to PPPs to provide information related to PPP initiatives in the country. The website serves as a hub of information on PPP initiatives and contains related policy documents, government guidelines issued for mainstreaming PPPs. These include information on the institutional mechanisms for speedy appraisal of PPP infrastructure projects and the scheme for financial support to PPP projects. G20. The G20 was formed in 1999 as a forum of finance ministers and central bank governors in recognition of the fact that there was a major shift in the global economic weight from the advanced economies to emerging market economies. G20 rose into true prominence in 2008 when it was elevated from a forum of finance ministers and central bank governors to that of the G20 heads of the nation in order to effectively respond to the global financial crisis of 2007 to 2010. BRICS. The BRICS nations of Brazil, Russia, India, China, and South Africa form the 5 key pillars of South-South cooperation and are the representative voice of emerging markets and developing countries in the global forums such as G20. BRICS Bank is also known as New Development Bank (NDB). United Nations Development Programme. The United Nations Development Programme (UNDP) is the largest channel for development cooperation in the UN. The overall mission of the UNDP is to assist the program countries through capacity development in Sustainable Human Development (SHD) with priority on poverty alleviation, gender equity, women empowerment, and environmental protection. The overall mission of the UNDP is to assist the program countries through capacity development in Sustainable Human Development with priority on poverty alleviation, gender equity, women empowerment, and environmental protection. South Asian Association for Regional Cooperation. The South Asian Association for the Regional Cooperation (SAARC) is a regional organization that aims to promote economic, social, cultural, technical, and scientific cooperation in the South Asia. Its member states include Afghanistan, Bangladesh, Bhutan, India, Nepal, Maldives, Pakistan, and Sri Lanka. SAARC Development Fund (SDF). SDF was established in 2008 by the SAARC countries to improve the livelihood of the people and to accelerate economic growth, social progress, and poverty alleviation in the region. Bilateral cooperation. Department of Economic Affairs also deals with bilateral development assistance from G8 countries, namely USA, UK, Japan, Germany, Italy, Canada, and Russia Federation, as well as European Union. The division also deals with the work relating to extension of the lines of credit to developing countries. The division also deals with the work relating to extension of lines of credit to developing countries. Bilateral official development assistance. India has been accepting external assistance from bilateral partners in the form of loans, grants, and technical assistance for development of infrastructure, social sector, and for enhancement of knowledge or skills of Indian nationals at both center and state level. International Monetary Fund. India is a founder member of the International Monetary Fund (IMF), which was established to promote a cooperative and stable global monetary framework. At present, 188 nations are members of the IMF. Since the IMF was established, its purposes have remained unchanged, but its operation, which involves surveillance, financial assistance, and technical assistance, have developed to meet the changing needs of its member countries in an evolving world economy. World Bank. India is a founder member of the International Bank for Reconstruction and Development (IBRD). International Bank for Reconstruction and Development, which along with International Development Association IDA is referred to as World Bank. India is a founding member of the International Bank for Reconstruction and Development IBRD, which along with International Development Association IDA is referred to as the World Bank. IBRD has 189 member countries. It provides loans, guarantees, risk management products and advisory services to middle income and credit-worthy low-income countries, as well as coordinates responses to regional and global challenges. International Finance Corporation. International Finance Corporation IFC, a member of the World Bank Group, focuses exclusively on investing in the private sector in developing countries. The IFC's investments in India are spread across important sectors like infrastructures, manufacturing, financial markets, agribusinesses, SMEs, and renewable energy. New Development Bank. The New Development Bank (NDB) has been instituted with the vision to support and foster infrastructure and sustainable development initiatives in emerging economies. The founding members of the NDB, that is Brazil, Russia, India, China, and South Africa, that is the BRICS nations. The purpose of the bank is to mobilize resources for infrastructure and sustainable development projects in BRICS and other emerging economies as well as in developing countries. India is one of the largest borrowers from the banks in sectors of transport, health, water, and financial sectors. Asian Infrastructure and Investment Bank AIIB. Asian Infrastructure Investment Bank AIIB is a multilateral development bank MDB set up to foster sustainable economic development, create productive assets and improve infrastructure in Asia through financing of infrastructure projects. India is one of the founding members and the second largest shareholders. India along with 20 other countries signed the Intergovernmental Memorandum of Understanding MOII for establishing the AIIB in Beijing. International Fund for Agriculture Development. International Fund for Agricultural Development IFAD is a specialized agency of the United Nations based in Rome. IFAD is the only specialized global development organization exclusively focused on and dedicated to transforming agriculture, rural economies, and food systems. At present, IFAD has 177 member countries. India is a founder member of IFAD and a key contributor. It is dedicated to eradicating poverty and hunger in rural areas of developing countries. Global Environment Facilities GEF. The Global Environmental Facility GEF operates as a mechanism for international cooperation for the purpose of providing new and additional grant and concessional funding to meet the agreed incremental costs of measures to achieve agreed global environmental benefits. The Global Environmental Facility operates as a mechanism for international cooperation for the purpose of providing new and additional grants and concessional funding to meet the agreed incremental cost of measures to achieve agreed global environmental benefits. Asian Development ADB. Asian Development Bank ADB envisions a prosperous, inclusive, resilient and sustainable Asia and the Pacific while sustaining its efforts to eradicate extreme poverty in the region. ADB assists its members and partners by providing loans, technical assistance, grants and equity investments to promote social and economic development. It has 68 members including 49 regional and 19 non-regional members with its headquarters in Manila, Philippines. Currency and coinage, security printing and minting Corporation of India Limited. Security Printing and Minting Corporation of India Limited SPMCIL is the only PSU under the Department of Economic Affairs. It was formed after corporatization of 9 units, that is 4 mints, 4 presses, 2 currency note presses and 2 security presses, and 1 paper mill, which were earlier functioning under the ministry. Security Printing and Minting Corporation of India Limited is the only PSU under the Department of Economic Affairs. It was formed after corporatization of 9 units, that is 4 mints and 4 presses, 2 currency note presses and 2 security presses, and 1 paper mill, which were earlier functioning under the ministry. It is engaged in the manufacturing of security papers, minting of coins, printing of currency and banknotes, non-judicial stamp papers, postage stamps, travel documents, etc. National Investment and Infrastructure Fund. The Government of India has put investment in infrastructure as one of the core elements of its economic program. National Investment and Infrastructure Fund (NIIF) was created with the aim to attract equity investments from both domestic and international sources for infrastructure development in commercially viable projects, both greenfield and brownfield, including stalled projects. National Investment and Infrastructure Fund. The Government of India has put investments in infrastructure as one of the core elements of its economic program. National Investment and Infrastructure Fund (NIIF) was created with the aim to attract equity investment from both domestic and international sources for infrastructure development in commercially viable projects, both greenfield and brownfield, including stalled projects. International investment treaties and framework. India initiated the exercise to negotiate and enter into bilateral investment treaties (BITS), bilateral investment promotion and protection agreements (BIPAs) with other countries as a part of comprehensive economic reforms program, which was initiated in 1991. A BIT, that is bilateral investment treaties, is essentially an international treaty which increases the comfort level and boosts the confidence of the investors by assuring a minimum standard of treatment and non-discrimination in all matters, while providing for an independent forum for dispute settlement through arbitration. In turn, BITs are expected to project India as an attractive foreign direct investment destination (FDI destination), as well as protect outbound Indian FDI abroad, as well as protect outbound Indian FDI abroad. Department of Expenditure. The Department of Expenditure is the nodal department for overseeing the public financial management system in the central government and matters connected with state finances. It is responsible for implementation of the recommendation of the Financial Commission and Central Pay Commission, monitoring of audit contents, monitoring of audit comments, and observations, and preparation of central government accounts. Department of Expenditure. The Department of Expenditure is the nodal department of the overseeing the public finance management system in the central government and matters connected with state finances. It is responsible for the implementation of the recommendation of the Finance Commission and Central Pay Commission, monitoring of audit comments or observations, and preparation of central government accounts. Controller General of Accounts (CGA). The Controller General of Accounts (CGA) in the Department of Expenditure is the principal accounting advisor to the Government of India and is responsible for establishing and maintaining a technically sound management account system. Public Financial Management System. The Public Financial Management System (PFMS) is a web-based online software application designed, developed, owned and implemented by CGA, Controller General of Accounts, with the aim to provide a sound public financial management system by establishing a comprehensive payment, receipt and accounting network. Non-tax receipt portal. The objective of the non-tax receipt portal (NTRP) is to provide a one-step a one-stop window to citizens, corporates, institutions, other users for making online deposits of non-tax receipts (NTR) which are payable to the Government of India. इसको फिर से देख लेते हैं. Non-tax receipt portal. The objective of non-tax receipt portal (NTRP) is to provide a one-stop window to citizens or corporates or institutions or other users for making online deposit of non-tax receipts (NTRs) which are payable to the Government of India. Institute of Government Accounts and Finance, INGAF, is the training arm of the Controller General of Accounts. Central Pension Accounting Office. The Central Pension Accounting Office (CPAO) was established in 1990 for payment and accounting of central or civil pensioners and pension to freedom fighters, etc. CPAO is a subordinate office under the Office of Controller General of Accounts, Ministry of Finance. It has been entrusted with the responsibility of administrating the scheme of payment of pension to central government civil pensioners through authorized banks. Its core functions are issue of special seal authorities (SSAs), authorizing payment of pension in fresh as well as revision of pension cases to the CPPCs, Central Pension Processing Centers, of pensions disbursing banks, preparation of budget for the pension grant and accounting thereof, maintenance of data bank of central civil pensioners containing all details indicated in the PPOs, and revision authorities, and handle the grievances of central civil pensioners. इसको फिर से देख लेते हैं. Its core functions are issue of special seal authorities (SSAs), authorizing payment of pension in fresh as well as revision of pension cases to the CPPCs, Central Pension Processing Centers, of pension disbursing banks, preparation of budget for the pension grant and accounting thereof, maintenance of data bank of central civil pensioners containing all details indicating in the PPOs and revision authorities, and handle the grievances of central civil pensioners. Arun Jaitley National Institute of Financial Management. The Arun Jaitley National Institute of Financial Management (AJNIFM) was set up in 1993 as an autonomous body to impart training to officers recruited by the Union Public Service Commission (UPSC) through the annual civil service exam, and allocated to the various services responsible for managing senior and top management posts dealing with accounts and finance in the Government of India, and to develop as a center of excellence in the areas of financial management and related disciplines, not only in India but also in Asia. The institute adheres to norms prescribed by the All India Council for Technical Education (AICTE) in respect of faculty qualifications and strengths. Revision of General Financial Rules. The General Financial Rule (GFRs) are rules and orders dealing with matters involving public finances. Department of Revenue. The Department of Revenue exercises control in respect of revenue matters relating to direct and indirect union taxes through two statutory boards, namely the Central Board of Direct Taxes (CBDT) and the Central Board of Excise and Customs (CBEC). The department is also entrusted with the administration and enforcement of regulatory measures provided in the enactments concerning central sales tax, stamp duties, and other relevant fiscal statutes. Control over production and disposal of opium and its products is vested in the department. Control over production and disposal of opium and its products is vested in this department. Goods and Services Tax Legislative Department Development. Goods and Services Tax Legislative Development. GST was implemented in the country in July 2017, subsuming of various central indirect taxes and levies such as central excise duty, additional excise duties, excise duty levied under the Medical and the Toilet Preparations Excise Duties Act 1955, service tax, additional custom duty commonly known as countervailing duty, special additional duty of customs, and central surcharges and cess so far as they relate to the supply of the goods and services. Coverage of all goods and services except alcoholic liquor for human consumption is meant for the levy of goods and services tax. GST Goods and Services Tax. The Constitution was amended to provide concurrent powers to both center and states to levy goods and services tax GST on goods and services. Subsequently, the GST Council comprising the Union Finance Minister MOS, Finance and Financing Ministers of all states is empowered with making all policy decisions on GST. फिर से देख लेते हैं. Subsequently, the GST Council comprising the Union Finance Minister MOS, Finance and Finance Ministers of all states is empowered with making all policy decisions on GST. More than 17 taxes and 13 cesses have been subsumed in GST, making India one nation, one tax. Indian Stamp Act. The Indian Stamp Act 1899 is a fiscal statute laying down the law relating to tax levied in the form of stamps on instruments recording transactions. Central Board of Direct Taxes. Direct Taxes. The Central Board of Direct Taxes CBDT, created by the Central Boards of Revenue Act 1963, is the apex body entrusted with the responsibility of administrating direct taxes laws in India. It is the cadre controlling authority for the Income Tax Department ITD. With modern information technology as a key driver, the CBDT has implemented a comprehensive computerization program in the Income Tax Department. The program is aimed to establish a taxpayer-friendly regime, increase the tax base, improve supervision, and generate more revenue for the government. The endeavor is to promote voluntary compliance by taxpayers and create a non-intrusive and non-adversarial tax administration. Abolition of dividend distribution tax DDT. In order to increase the attractiveness of the Indian equity market and to provide relief to a large class of investors in whose case dividend income is taxable at the rate lower than the rate of DDT, the Finance Act 2020 removed the dividend distribution tax under which the company shall not be required to pay DDT from 2020-21. The dividend income shall be taxed only in the hands of the recipient at their applicable rate. Personal income tax. In order to reform personal income tax, Finance Act 2020 has provided an option to individual taxpayers for paying income tax at lower slab rates if they do not avail specified deduction and exemptions. International Financial Services Center IFSC. Various tax incentives have been provided for units located in International Financial Services Center IFSCs in order to make it a hub for financial services in the world. Further incentives have been provided in the Finance Act 2021, like tax holiday for capital gains for aircraft leasing companies, tax exemption for aircraft leasing rentals paid to foreign lessors, tax incentives for relocating foreign funds into IFSC, and allowing tax exemption for the investment division of the foreign banks located in IFSC. Legislative changes. Changes in personal income tax rates. In order to encourage more people to come within the tax net and also to reduce the burden of taxation on honest taxpayers and salaried employees who are showing their income correctly, the tax rate for individual assesses earning incomes between 2.5 lakh rupees to 5 lakh rupees, 2.5 lakh rupees to 5 lakh rupees was reduced to 5% from the earlier rate of 10%. Changes in corporate income tax rates in order to make MSME companies more competitive as compared to large companies, and also to encourage firms to migrate to company format. Tax rate for smaller companies with annual turnover up to 50 crore rupees in the financial year 2015-16 was reduced to 25%. Percentage wise, this will benefit 96% of the companies in this category. PAN quoting mechanism. Statutory provision for deduction of tax at source TDS at higher rate of 20% or the PAN applicable or the applicable rate whichever is higher in case of non-quoting the permanent account number PAN is made under section 206 AA of the Income Tax Act since April 2010. Statutory provision for deducting the tax at source TDS at the higher rate of 20% or the applicable rate whichever is higher in case of non-quoting or permanent account number PAN is made under section 206 AA of the Income Tax Act since April 2010. PAN acts as a common thread for linking the information in departmental database. Promoting digital transaction. A new section 269 ST was inserted in the Income Tax Act which inter alia restricts acceptance of cash of 2 lakh rupees or more in the circumstances specified therein through mode other than an account pay check or an account pay bank draft or use of electronic clearing system through a bank account. Promoting digital payments for small unorganized businesses. In order to promote digital transactions and to encourage small unorganized business to accept digital payments, Section 44 AD of the Income Tax Act has been amended to reduce the existing rate of deemed total income of 8% to 6% in respect of the amount of such total turnover or gross receipt received by an account pay check or account pay bank draft or use of electronic clearing system through a bank account. Aadhaar in PAN applicable form and return of income. A new section 139 AA has been inserted in the Act. With this, every person who is eligible to obtain Aadhaar number shall, on or after the first day of July 2017, quote Aadhaar number or enrollment ID of Aadhaar application form in the return of income or PAN application form. Ease of compliance for taxpayer number 17R for specified senior citizens. Through Finance Act 2021, a new section 194P has been inserted to the Income Tax Act 1961. The Act to provide that in case of senior citizen of the age 75 years or above having only pension income and interest income only from the accounts maintained with a bank in which they receive such pensions, then such senior citizens shall not be required to file their income tax returns ITR. Relaxation to NRIs. When non-resident Indians NRIs return to India, they have issue with respect to their accrued incomes in their foreign retirement accounts due to a mismatch in taxation periods. Faceless appeals. Faceless appeal scheme has been launched in 2020. The scheme provides a fully faceless procedure for appeals to Commissioner of Income Tax Appeals. Like the faceless assessment scheme, it allows the taxpayer to file their documents in an electronic mode and thereby save them from the hassles of physically visiting the income tax department. Faceless penalty. Faceless Penalty Scheme 2021 was launched to impart greater efficiency, transparency, and accountability to the procedure for imposition of penalty. The scheme eliminates the physical interface between the income tax official and the taxpayers and provides for optimal utilization of resources and a team-based mechanism for imposition of penalty by one or more income tax authorities with dynamic jurisdiction. Faceless or TAT. The Finance Act 2021 has empowered the government to notify a scheme for the purpose of disposal of appeals by the appellate tribunal so as to impart greater efficiency, transparency, and accountability by eliminating the physical interface between the appellate tribunal and parties to the appeal in the course of appellate proceedings to the extent technologically feasible, optimizing utilization of the resources through economies of scale and functional specialization, and introducing an appellate system with dynamic jurisdiction. Reduction in time for income tax proceedings. The Finance Act 2021 has reduced the time limit for reopening of assessment to 3 years from the earlier 6 years. Pre-filing of income tax returns. In order to make tax compliance more convenient, pre-filed DR have been provided to individual taxpayers. The ITR form now contains pre-filed details of certain income such as salary income. The scope of information for pre-filing is being further expanded by including information such as interest, capital gains, capital gains, etc. Taxpayer registration. Permanent account number PAN is a 10-digit alphanumeric number allotted by ITD to taxpayers. Income Tax Department ITD. It enables ITD to link all transactions of the taxpayer with the department. Income Tax Department has allotted more than 50 crore PAN. Income Tax Department has implemented the integration of PAN allotment process with incorporation of a company through the eBiz portal. A facility for instant allotment of PAN on near to real-time basis is available for those applicants who have a valid Aadhaar number and have a mobile number registration or registered in Aadhaar. Payment of taxes. The online tax account system OLTAS facilitates near real-time reporting, monitoring, and reconciliation of tax payments made by taxpayers through banks. E-payments of taxes have been enabled through net banking and ATMs, and nearly 89% of the taxes is collected through this mode, facilitating payments of taxes anytime from home or office without having to go to the bank branch. Electronic filing of the income tax returns and other forms. The e-filing website provides facility for online filing of income tax returns and various types of forms, including audit reports, application and informational statements by taxpayers. This facility is free of cost to taxpayers. E-file returns now account for more than 99% of the total returns filed with the department. Centralized processing to the income tax returns. Centralized Processing Center for Income Tax Returns CPCITR at Bangalore leverages the availability of data in the electronic format. CPCITR provides a comprehensive and end-to-end solution to taxpayers to process the return using rules as per provisions of the Income Tax Act in an automated environment to compute the final refund or tax due to taxpayer. Taxpayer facilitation and assistance. Aayakar Seva Kendra ASKs were set up under Sevottam as a single window computerized service mechanism for centralized receipt of returns, application, grievances, and distribution of DAC in various income tax offices. Computer Assisted Scrutiny Selection (CAS). Income Tax Department has been leveraging data analytics and risk assessment for promoting voluntary compliance and deterring tax evasion.